All right, so let's jump right into a corner of tax law that deals with a pretty wild question, one you've probably never even thought to ask. But trust me, once you hear it, you'll see why it's so important.
No, seriously, just imagine that for a second. You wake up, check your banking app, and bam, $1 million just sitting there. Your first feeling is probably, yes, I'm rich. But your second feeling, well, it should probably be, uh-oh, what am I going to tell the tax authorities?
Because believe it or not, the law has a whole set of rules for exactly this kind of situation. And we're not just talking about money magically appearing in an account. This applies to any kind of wealth, any asset, or even big spending that doesn't have a clear, logical story behind it. And that brings us to the core idea for today, deemed income. The key word here, the one you really need to lock onto, is deemed. It's just a legal way of saying treated as. So if you've got money or an asset and you can't explain where it came from, the law allows tax officers to just treat it as your income. And you know what that means? It can be taxed. This is pretty much the golden rule of this whole topic. If there's one thing you take away today, let it be this. Notice how the tables are turned here. It's not on the tax authorities to prove that this money is your income. Nope. The burden is entirely on you to prove where it came from. So let's start with the most obvious scenario, right? Just plain old cash showing up in your accounts. The rule that covers this is Section 68, and it's all about what they call unexplained cash credits. The actual wording in the law is really specific. It talks about a sum being credited in the books of an assessee. And assessee is just the formal legal term for the taxpayer, for you. And if you can't give an explanation that the tax officer finds satisfactory, then that money is getting added to your income for the year. And check out how deep that explanation has to be. Let's say you claim, oh, that money, it was just a loan. Okay, well, that's just step one. It's not enough. For step two, the person who supposedly gave you the loan also has to explain where they got the money from. And then, at the end of it all, the tax officer has to find both of your stories credible. If any single part of that chain seems off, the whole explanation can be thrown out. But this isn't just about cash in the bank. The same logic applies to unexplained ownership of things. What happens when you suddenly have investments, or gold, or expensive jewelry that you never recorded on your books? This chart breaks down a few different rules that are all pretty similar. For Section 69 and 69A, if you have investments or assets like gold that aren't on your books, their entire value can be considered deemed income. But look at Section 69B. It's a little more subtle. This one applies when the asset is on your books, but you've understated what it cost. In that case, it's only the excess amount, the part you didn't disclose, that gets taxed. Okay, so we've covered money coming in, and we've covered assets you have. But there's one more piece to this puzzle, money going out. What happens when you spend a bunch of money, but you can't really explain where you got the funds to do that spending in the first place?
Well, this is where Section 69C comes into play. If you've spent money but the source of those funds is a mystery, the amount you spent can be treated as your income. But oh boy, this rule has a particularly nasty twist to it.
And here's that twist. We're calling it the double penalty. Think about it. A normal, legitimate business expense, you get to deduct it from your income, which means you pay less tax. Great. But an unexplained expenditure does the exact opposite. First, the amount you spend gets added to your income, and then to add insult to injury, the law specifically says you are not allowed to deduct it as an expense. It's a real double whammy. So when you step back and you look at all these different rules, for money, for assets, for spending, what's the one common thread that ties them all together? It's the idea of a story, your financial story. This exact phrase, or something really close to it, shows up in every single one of these rules. It all boils down to whether your explanation is satisfactory in the opinion of the assessing officer. That's a subjective judgment call, and it's all about whether your story is credible. And that really is the most important thing to take away from all this. When it comes to unexplained wealth, the whole system is kind of flipped upside down. It's almost as if you're assumed guilty until you can prove yourself innocent. The burden of proof is completely, 100% on you to keep good records and be able to tell a clear, consistent, and believable story about your finances. Which leaves us with one final thought to chew on. In a world where basically every transaction leaves a digital footprint, maybe the whole idea of unexplained wealth is changing. Maybe the real challenge for us today isn't so much about what's hidden, but more about our simple duty to document everything clearly and honestly. Something to think about.